Imagine you're saving money and trying to build a future. You work hard, you maybe even take on a loan, and you put some money into investments because everyone says that that's how you get ahead. But then the economy crashes. Jobs are lost, stock prices fall, and suddenly people wonder, was I actually safe? Did I make the right choices? And, that's what I really want to talk about today. How debt, stocks, and cash really behave when times get tough, and what that means for ordinary people like us. Now, debt, let's start with debt. Debt feels helpful when things are going well, especially if you use it to buy assets that grow faster than your interest. And as long as your paycheck keeps coming in, it doesn't feel too heavy. But here's the problem: when a crash comes, debt doesn't automatically go away. It stays exactly the same, no matter what. I mean, unless you declare bankruptcy, I suppose. But picture two families. Family A has a mortgage, car loans, and credit card debt. So when they lose their jobs in a crash, they still have to pay all those bills to survive. They might even have to sell their investments at the worst possible time, when prices are at rock bottom, if not even their house at rock bottom pricing. Family B, on the other hand, has no debt. They lose their jobs too, but all they need to think about is food and basic expenses. No bank is chasing them. No monthly payments are hanging over their heads. So that's why debt is so dangerous. In good times, it feels fine, but in bad times, it can drag you under. Now, what about stocks? If you own shares, a crash can be actually terrifying. You might lose 30, 40, even 50% in a few months, if not days. But remember what stocks actually are: ownership in real businesses. Even when the stock market is panicking, Coca-Cola is still selling drinks, McDonald's is still flipping burgers, and Apple hopefully is still selling iPhones. The price on the screen that you see can drop, but the company itself does not vanish. And, if it's solid. And once the panic ends, stocks usually recover. And that's why, over the long run, stocks are still one of the best ways to grow wealth, even if the ride is bumpy. Now, cash cash often feels boring. It just sits there. Inflation eats away at it, and you don't get rich by holding cash. But in a crash, it turns into a superpower. It pays the bills when your income drops, it keeps you from selling stocks at the worst possible time, and it lets you buy investments cheaply, even when everyone else is being forced to sell. So think of it as a lifeboat. It won't move you forward in normal times, but when the ship is sinking, you'll be glad that it's there. Now, here's what's a bit worrying in today's world, and why I think we are possibly headed towards a bit of a bad period. The financial system has grown so big that companies often care more about boosting their stock price than actually making better products. I mean, take Tesla, for example. If you buy a $100,000 car, Tesla might make around about $4,000 in profit. But that barely changes Elon Musk's wealth. But if millions of people keep buying Tesla stock, the price rises and Musk's fortune can jump by billions overnight, even if car sales don't grow that much. So this is the world we live in, one where finance, buying and selling money sometimes matter more than the real economy of goods, services, and jobs. You have to take into account that finance in a healthy economy is supposed to be used as a tool. It's not the end goal itself. It should move money from savers to businesses. It should provide credit for homes and companies. It should manage risk through insurance and hedging. So in that role, finance should be small compared to the real economy. Historically, in the US and Europe, the financial sector produced around 2 to 4% of GDP and took about 10% of corporate profits. And that was enough to, oil the engine, the economic engine, without consuming it. But in today's reality, if we just go back to the 1980s, the US non-bank financial firms, so hedge funds, private equity, family offices, they held assets worth 40% of GDP. Now, today, they hold 200% of GDP in assets. And the sector now captures about 20% of all US corporate profits. In other words, finance has grown to be 2 to 5 to 10 times bigger than the real economy that it's supposed to serve, depending on how you look at it. This situation is where the finance industry is seen as a bit too big. When finance is small, it funds business growth. But when finance is huge, businesses start existing to serve finance itself. So buying back shares, leveraging balance sheets, and maximizing short-term stock prices rather than innovating. This is why critics say that we've gone a little bit beyond healthy capitalism into an era of financialization, where money chases money instead of building new products, jobs, and industry. The problem is, historically, it's been shown that when finance grows far faster than the real economy, it usually ends up in either two ways. It could end up in a crisis and a reset, like in 1929 or 2008, or a long period of stagnation where growth slows for decades, like in Japan in the 1980s. It's famously known as the lost decade of stagnation. So neither of these are actually good. So we have to be prepared to deal with these kinds of situations. So what can you do? So what's the lesson here, Well, you can't change how the whole system works, but you can decide how to position yourself inside it. You should definitely avoid too much debt. Try not to carry heavy anchors into a storm. So if you're buying a house, try to put down as much money as you can and take as little as you can from the bank through a mortgage. And same goes for the car. If you can, try to buy a car, maybe not as a good car as you could buy with finance, but maybe try to buy a shittier car in cash. Then second of all, you gotta own productive assets like stocks. They may fall in the short term, but they will recover and grow in the long term. And also third, probably the most important one, you gotta keep cash. Not too much, but enough to cover expenses and give you options when times are tough. It's generally recommended that you keep about 3 to 6 months worth of expenses in cash, but I would stretch that to even 12 months if you can. So you can not only survive a market crash and possibly losing your job for a while, but you could potentially also buy a bunch of assets at the best possible price. So you just want to think about it like building a boat, If you take the analogy, don't drill holes in it with debt. You want to use sales, which are basically stocks, to move forward over the years. The winds might change, they might actually blow against you, but they will actually move you forward in the long run. And keep life jackets, and that is cash for when the storm hits. So to sum this up, crashes aren't an if, they are a when. History shows us that markets always go through cycles of a boom and a crash. But if you understand how debt, stocks, and cash really work, you don't have to be afraid. You just have to prepare. So stay light on debt, own real businesses, healthy businesses, and keep some cash. And remember, when the storm passes, those who kept their boat afloat will be the first ones to sail again. Thank you for listening to this video, and I hope you've enjoyed it. I'll see you in the next one.